Ladies and gentlemen, we might just wait another 20, 30 seconds before we kick the webinar off, just to let everyone else join the call. Okay, I think we'll make a start. Well, good afternoon, ladies and gentlemen, and welcome to the Munro Partners webinar today. My name is Steve Fletcher. On behalf of all the distribution team at GSFM and Munro Partners, thanks for taking the time to tune into the webinar. First of all, I hope you're all well. Obviously, the COVID situation right around the country continues to be a very difficult one, in particular in New South Wales. I hope all of you on the call from Sydney and the regional areas of New South Wales managing okay during the lockdown, and we certainly hope the situation gets better very soon. Now, the format for the webinar today will be a Q&A style presentation. The team have compiled a whole range of questions, common questions we get from you, our clients, and the Q&A will run for around about sort of 30 to 40 minutes between Nick and I, and then we'll go to your questions. So please ask as many questions as you would like during the presentation. You can enter those questions at the Q&A box at the bottom of your screen, and then we'll go to those questions and endeavour to answer as many questions as we can at the end of the presentation. So the Munro Global Growth Fund had another very strong financial year, delivering 24.2%, which now sees the fund compound at 17% per annum since inception, which we're coming up to a 5-year inception date next month. To provide an update on the fund and discuss Munro's outlook on markets, I'm very pleased to be joined by Nick Griffin. Nick is a co-founder and he's also the Chief Investment Officer at Munro Partners. So Nick, here we go again. We're back on Zoom. We were supposed to be travelling around the country this week, but unfortunately that wasn't to be. We'll certainly get to each of the states as soon as we can, but first of all, welcome.
Yeah, thanks very much for having me, Steve. And this is our third one, I think, in lockdown, so thanks.
Yeah, well, let's hope the next one we're on the road. Now, before we get into the Q&A, Nick, I thought maybe a good place to start is for you to provide a quick Munro Partners business update. And then after that, we can go to the Q&A. So with that, I'll hand over to you, Nick.
Yeah, thanks very much, Stephen. And thanks very much, everyone, for dialing in. We really do appreciate the support and the interest in our products. And as Steve said, you know, we are going to go through the Q&A today, and we are going to attempt to show you some data and some insights into why we are reasonably positive markets here going forward and have a positive outlook. But just before we begin, I just wanted to, because there's a lot of new people on the call, just quickly remind you who Munro Partners is and quickly remind you how we think about the world, because we're going to be coming back to it quite a lot through the presentation, but I promise this won't take more than a few minutes. So just skipping through the first couple of slides. So Munro Partners was, as Steve said, formed 5 years ago next week here in Melbourne, Australia, to be your global growth investment manager. So our role is really to fill that global equities growth part of your portfolio. We felt there were a lot of good value managers in Australia and a lot of good global equity managers in Australia, but no one was really growth. We've done a 17% per annum return, as Steve said, since inception, and that actually adds on to the 10-year track record we had previously, where we did a 16% per annum return. So we've actually now got a 15-year track record of over 15% per annum returns. Unfortunately, it's not a straight line. We wish it was. It is a journey to get to that 15% per annum, but that's essentially what we do and how we fit in your portfolio. We run roughly $5.4 billion in assets under management. And as I've said in the past, there's three main reasons why we've managed to grow very quickly. On day one, we actually only had $20 million in assets under management. And those three main reasons are firstly, that track record that we spoke about. We had done this before. The process that we're talking about here today has been going now for 15 years. And a lot of people wanted to support us with that, including rating agencies, et cetera, that we got onto quite quickly. The second main reason is the reason Steve's here is Grant Samuel Funds Management. They distribute our product here in Australia. They're also owned by CI Financial in Canada, who distributes the product in Canada, and they've done a great job of distributing us around the world. And the last reason is probably why there's people dialed into this call, is because people realized that they needed a global growth manager. I think the simple way to think about it is back in 2015, you would go home and watch Netflix all night, but your fund manager wouldn't invest in it. And so our job is really to be your global growth manager, to be that sort of glass half full type person, and to think about what's possible in the future, not what's probable. And so from our point of view, we are effectively that growth manager, and that's where we fit in your portfolio. The team has continued to grow in terms of a business update. So now I'll just talk about, how our business has grown over time very quickly. We now have roughly 20 people, all based here in Melbourne, Australia. A lot of them on the call. So thank you for your help, guys, over this journey, and girls. And from that point of view, we are a partnership. So it's important to stress, we own and control roughly 75% of our business today, and we are aligned with the income that the business creates. We obviously also invest in the fund today. And we will continue to grow this business. So our success has meant we have invested more in what we do. We think we're quite good at what we do. We actually think we can get better, and we're going to spend more time and more money on this over the years ahead. Last thing, just by way of update, just to flag that the fund has evolved over time, and how you can access the fund has evolved over time. And so we are known, and most of the time today we're going to be talking about the Munro Global Growth Fund. That's our flagship product. It's an absolute return product. And so that means we're trying to give you significant risk-adjusted returns through the cycle. And so we think that is double-digit returns, so more than 10% per annum on a 3 to 5 year view after all the fees and expenses. And as I said at the start, we've actually done that now across a 15-year time horizon. This product is, with downside protection, so I'm sure we'll get to that, about how we manage risk through the cycle. And that product is an absolute return product that runs at a beta of about 0.7. Some may have also noticed that product is now quoted on the Australian Stock Exchange under the code MAET, or MATE, as we like to know it. And that really fulfills the goal of what we started out trying to do, which is for you as an investor to you sort of wake up one day to buy some shares in MATE, and tomorrow you will own literally a share of the largest wind turbine manufacturer in Denmark. You'll own a Taiwanese semiconductor foundry, you'll own a US software company, and you'll basically get access to some of the greatest growth companies in the world that we think. And the day you don't want to hold them anymore, you can just sell it. Also important to flag, we do run the strategy as a long-only strategy on the right there. That's the Munro Concentrated Global Growth Fund. And so this is effectively the same idea as just on the long side. So with no shorts, no capital protection, and fully invested all the time. And so those are the two products that we run. They're both to access great global growth ideas, and they're both available thanks to Grant Samuel on most major platforms today. So lastly, just by way of introduction, and apologies for the people who've seen these next two slides before, but I promise it is the last two. It's just to remind people how we invest, because we're going to keep coming back to this as we talk through the outlook today, which I know can be a little bit confusing. But from our point of view, how we invest is not. It's very, very clear, and it's very, very simple. And it's held us true through all these difficult periods. And so our philosophy, as I said, is incredibly simple. Earnings growth drives stock prices. So we generally find that companies that make more money every year, we generally find their share prices go up. Sustained earnings growth is worth more than cyclical earnings growth, and the market always misprices growth and its sustainability. So during the Q&A today, we're going to keep coming back to this point, is that the companies ultimately follow their earnings. This is effectively our North Star. And our North Star is to really identify these companies that have strong structural growth over the medium term, like MasterCard on the left there, and to effectively get their share prices to follow that growth. And what we're showing you here is the blended forward EPS growth of MasterCard over the cycle and its share price. And on the right, we're showing you the blended forward EPS growth of Bank of America and its share price. And so our process is quite simply to ignore this situation, Bank of America, and to really focus on this situation, MasterCard. Because what we observe is that the market is often mispricing growth and sustainability. So even though everybody knows that MasterCard's a beneficiary from the shift from physical to digital cash, the market seems incapable of pricing it in. On the flip side, Bank of America, while it's a great bank and I'm sure for some people a good investment, we just don't really have an edge on where these earnings are going to go. We don't really have an edge on what we're looking for. It relies on the macroeconomic situation. And there, ultimately we have a view, but our view is as good as other people. The last thing just to flag here and just to remind people is that from our point of view, when we think about constructing these portfolios, a lot of people, when they're building funds, will think about being over or underweight countries or over or underweight sectors. And we just think that's a complete waste of time. On the whole time we've been looking at equity markets is a game of very few winners and lots of losers. Your job is actually to find those few winners. And they're usually driven by structural trends. And so what this slide shows you is this just shows you a study done by a guy called Henrik Bessenbinder. I've showed it lots of times before. And what he flags that is if you bought and held every company that ever listed in the United States over the last 90 years, you'll find it's 25,300 companies. But you'll also find that just the top 1,000 of them actually generate the entire wealth of the US stock market. So 4% of all statistical observations. And the top 50 create nearly 50% of that value. And so that's 50 companies out of 25,300 over 90 years that create nearly 50% of the entire wealth of the US stock market. And we're showing you for them on the right there. And they're always driven by structural change, whether that's digitization with Amazon, Facebook, and Google, whether that's big box retailing with Home Depot and Walmart, whether that's software with Microsoft and Oracle. The reality is equities are really driven by these big structural changes. And your job is to find these big structural changes and then to find the winners. And so once we've got through, I'm sure, all the obligatory questions about COVID and inflation and everything else, we are going to try and get back to this point of really focusing on, this area at the top left where we essentially occupy to basically identify these big structural changes and try and find those winners, because that's actually what's going to make us money over the next 3 to 5 years. And that's actually what you're paying us to do. And so I just wanted to remind people of that before we began, because I'm sure we're going to keep coming back to it as we go along. And so with that, Fletch, I'll stop and I'll let you fire away at some of these questions.
Okay, terrific. Thanks, Nick. Okay, so let's get into the first one. I think a really good place to start is to talk about the current COVID situation. With the Delta variant sweeping the world, obviously, no one has the answers to this, but how are you and the team at Munro thinking about how the COVID crisis could evolve from here and potential scenarios for investors?
Yeah, so thanks, Steve. Look, COVID is obviously, a hugely distressing thing that's happened in a lot of people's lives over the last couple of years, and I think people are right to be concerned about it. And obviously, we debated whether we'd show this slide or not, to be honest, because everybody, if you just have to hang around at a coffee shop in Melbourne or Sydney to know that everyone seems to be an epidemiologist as to how this thing's going to evolve. So what we decided to do is to basically show you some of the data that we're looking at. And I think for most people on the call, they'd probably be confused to see that, that Sydney and Melbourne are in lockdown, but the market is not falling. And the Delta variant is everywhere, yet the market is not falling. And the reason why it's not falling like it did last year is because over this crisis, we are progressing slowly out of a pandemic towards an epidemic. And this is the data that I think most of the market's looking at, and it's definitely the data we're looking at. And so what I'm showing you here is case numbers in the United Kingdom. Case numbers since the crisis began in the dark blue line, and in the light blue line, I'm showing you deaths, or we're showing you deaths. And obviously this is a bit morbid, but the reality is if you look to the far right, you'll see there's a very strong indication that the vaccine is efficacious. At this point in time, at the last peak, the UK had 4% of the population had 1 dose and virtually nothing had 2 doses. And here we are on the 24th of July, 88% of the UK population has had 1 vaccine dose and over 70% has had 2 doses. And you can see a strong disconnect between cases and deaths and a strong disconnect between cases and hospitalizations. And so that points to strong vaccine efficacy. On top of that, you're actually now starting to see these case numbers come down in the UK. It's only got a 5-day history. And there's also some discussion that, potentially over 90% of people in the UK have antibodies either by the vaccine or have already had COVID. And so we would argue that potentially we're a lot closer here to herd immunity in places like the UK and the US than a lot more people think. And so while we know it's not going to be a smooth ride to getting there, and Australia is clearly a case in point here, the reality is the market is quite rightly looking at the efficacy of the vaccine data, and it is still good. And also knowing that we have boosters up our sleeves for the future and making a fairly rational assumption that ultimately, that this will evolve over time and evolve into an epidemic. That is, I suppose, our base case view on COVID. The last thing I'd just say from the market point of view is what we also learned in the last 12 months is that, or 2 years, is that companies can pivot. And so the earnings of corporates is highly unlikely to be affected by these mutant variants that come along. And yes, it will make the recovery slow and bumpy and uneven, and particularly by regions, but I don't think it will derail the recovery altogether. And I suppose that's the data we're looking at. And obviously huge disclaimers on that because we know the situation can change, but that's what we see today.
Okay, so that leads on to the next question. And I think you would remember we ran a webinar, as we discussed today, back in February for clients, where the key discussion point at that time was around the potential for inflation and rising bond yields. So since then, we've watched global rates tumble, which initially started in April this year with the US 10-year peaking at 1.74% and rallying to where it is today at 1.29. So I've got two questions for you here, Nick. The first one is, what do you think the bond market is seeing here? Is it that growth may have peaked, or is there something else? And the second part of the question is around equities, and do you think equities can continue their huge run? Can markets keep going higher from here?
Yeah, thanks, Steve. So what I might do is actually reverse those questions and start with the valuation and then work back to the bonds, because they are actually connected. And so this is probably the best slide to show how well they are connected, bonds versus equities at the moment. So if you look, I understand that there are pockets of overvaluation in the market, and there are clearly pockets of irrationality in the market. But if you look at the equity market as a whole, it does not look expensive to us versus bonds. This is a good slide that just shows the earnings yield of the S&P 500. So effectively 1 divided by the PE, and if the PE was 20, then the earnings yield of the market is roughly 5% today. And then if you subtract the risk-free rate, which is the US 10-year, of roughly 1.2, 1.3%, you're getting just a 3.5%, 3.7% carry for owning equities today in the United States, broadly for the S&P 500. And if you look at that over time, that's very stable. I mean, ultimately, we've been running at sort of a 3 to 4% equity risk premium now for nearly 20 years. And while the market may look expensive, it's nowhere near as expensive versus bonds as it was back in 1999 back here. Now, the key thing that everyone's obviously going to point out here is that interest rates back here were 8% and interest rates here are 1.3%. And so the question you have to ask yourself as an investor today is, what's going to cause this gap to close? What's going to cause it to close? And so there are three things that can make it close. Firstly, earnings collapse. Earnings collapse like they did during COVID or like they did during the financial crisis. And I think, coming back to what I said earlier, I think that's unlikely at this point in time. We are, albeit bumpily, on a road to an economic recovery. And so earnings, I think, are unlikely to collapse here. The second thing that could happen is that the market goes up a lot. That's the gap that then things close here and the market goes up a lot. And the third thing is that interest rates can go up a lot. And so it really becomes a battle between those two things. And so a lot of what we've seen from the year to date is really this battle over where are long-term interest rates going to come out of this. And the recovery and the inflation tensions have obviously been forcing that. From our point of view, though, if you take a really big step back, interest rates have been on a steady progression lower for a very long period of time. And there are forces that have been causing that for a very long period of time, pre-COVID, and none of those forces have changed post-COVID. And the first and most important one is debt. And so what we're showing you here is the US 10-year bond yield over time versus nominal GDP and total debt outstanding over time. So what you can see is as debt goes up, growth goes down, and US 10-year bond yields go down. And so from our point of view, you have sort of these stagflation periods, these pre-GFC, these post-GFC, and now these post-COVID periods. And so from our point of view, if anything, COVID debt has actually gone up significantly through the COVID period. And so from that point of view, that puts a natural weight on long-term interest rates. Think of it a different way. If interest rates went up a lot from here, then inevitably we're going to go into a recession. And that recession will force rates back down again. And so when the Fed actually makes a nod to long-term inflation expectations, or when they make a nod to that they might tighten to deal with inflation expectations, they effectively anchor long-term interest rates. And what the market's doing is looking at this and saying, actually, I think long-term interest rates are potentially anchored. The second thing that's still out there and that we know about pre the crisis and is still the same post-crisis is demographics. Demographics continue to work against long-term interest rates because you have people that are getting older with an excess savings boom, and then obviously less people in the world generally, i.e. on population. And the last thing that we know about before the crisis that is still the same post the crisis is technology. And so you'll hear us talk a lot about Moore's Law, or a lot of people have heard us talk a lot over the last 5 years about Moore's Law. The reality is we live in a time of accelerating compute power, i.e. the doubling of transistors on a semiconductor means computers get exponentially faster over time. And that exponential speed in computers creates exponential disruption. And so for the people on the call who try to understand this, the reality is the internet, when we first started using it, could only send an email. But as computers get faster, it creates search. As computers get faster, it gets on your phone. Edge computers get fast as it shares pictures, then it does e-commerce, then it does payments, then it does software. And all of these effects are deflationary. They are all deflationary and they all massively improve productivity. And I think the big one we've all learned in the last 12 months is how important software is in our life, and how deflationary it is. I mean, put simply, Steve, we are for the third time doing our global roadshow on Zoom, or sorry, our Australian roadshow on Zoom. And so that's a whole bunch of money that we would have spent traveling around Australia that we now spend on a $500 Zoom subscription. And so these deflationary effects are in the market, and there's nothing we can really do to stop them because we know computers will get faster. And so if you put that together, this is, I suppose, the one telling data point that we would argue as to why long-term interest rates have probably peaked a bit earlier than what most people think. The first is obviously this rumbling through of COVID, but the second is really this wonderful productivity boom that we've had through COVID. And so on the left here, we're showing you the GDP of the United States over the last 20 years. And on the right, we're showing you the employment over the last 20 years. And so what you can see here quite clearly is gross domestic product has actually gone down through COVID and got back to its previous peak, all in the space of effectively 18 months. But employment collapsed during COVID and has only got back to here. And so you've effectively got back to the same level of GDP with 8 million less employees. And that sort of tells to the productivity boom that we've seen. And so from our point of view, if you're the US Fed, you have a dual mandate, inflation and employment, and you're going to have to run rates lower for longer. A, because there's too much debt in the world that you're trying to grow out of, and B, because your employment mandate's probably not going to be reached in the short term. And that's really a function of those two things, which gives you this anchored level of long-term interest rates. And the inflation argument, while I see it and it's around us and it's prevalent, and I'm not saying we won't see higher inflation, I just don't think we necessarily see much, much higher long-term interest rates. And that's all you're seeing the market price in today.
Okay, so considering that outlook that you've just laid out, can you discuss positioning in your portfolio? And has there been any material change from how you were positioned, say, 6 months ago, the start of the year, to where you are now?
Yeah, okay, thanks, Steve. So if you just summarize the big questions that we tried to answer there right at the start of the webinar, is firstly, COVID, while still prevalent and difficult, is probably not the issue that equity markets are going to face in the next 12 months. We will muddle our way through the COVID crisis. Unfortunately, many people are going to die here who probably don't need to, but ultimately the vaccines will work and the vaccines will have boosters in the future. So we do think we'll muddle our way through that. The second thing we're probably flagging is long-term interest rates are anchored. And the reopening as we see it is really a one-time event. And so what we now need to do now is look beyond that and look beyond to find the earnings growth that we're looking for. And so from our point of view, that just brings us back to these S-curves. And this is what we thought at the start of the year, and it's still the case today. And so if you think about the world post-COVID, it's probably going to be a slower growing world with lower interest rates. And your job really is to go find these S-curves of structural growth. That's what we do at Munro Partners. That's what we've done for 15 years. And that's what I think we're still going to have to do into the future. For those of you who haven't seen us present before, a good example of the S-curve is really this mobile phone situation that we saw through 2008. And so back in 2008, you used to sell 1.6 billion phones per annum. You now sell 1.7. So mobile phones don't grow. But smartphones come along, go from a 10% share to an 80% share. And as we all now know, Apple's revenues go from 27 billion to 250 billion. Its revenues go up 10 times, its earnings go up 20 times, and it goes from a 50 billion market cap company to 2 trillion today and to the biggest company in the world, all driven by iPhone. And so your job, and all of this happens, whether Donald Trump gets elected, it happens whether Europe goes broke, it happens whether inflation is there, it happens whether inflation's not there. It is a structural growth trend, and these are the things we're trying to find, because as I said right at the start, it's ultimately earnings growth that are going to drive the stock prices from here. And while there is noise out there, it is really that earnings growth that we should be looking for, not on a 6-month view, but on a 3 to 5 year view. And so from our point of view, these are the S-curves we've been following for some time. And so these are how the fund was positioned last year. Obviously, these stocks have had a slower first half of the year this year, but we still think they're the place to be. And so it's still how the fund's positioned this year. What we're showing you here is the penetration of a number of S-curves that are occurring around the world today. The first and most obvious one is e-commerce, which has effectively gone from a 5% share to a 20% share pre-COVID, and then accelerated through COVID. Cloud computing's effectively gone from nothing to 40%. Digital advertising has gone from nothing to nearly 50% of all advertising. And then, of course, there's the card versus payment shift that we've been talking about at the start of our presentation. Now, all of these S-curves of adoption actually accelerated during COVID. And we just see no evidence to suggest that that acceleration is going to slow down. In our view, a lot of the habits that we picked up through COVID, we're likely to keep, whether that's ordering groceries online, which is why we like HelloFresh, or whether that's hybrid work environments, which is why we still like Microsoft and ServiceNow. These are core positions in the fund and they're core holdings today. From our point of view, all we've done here is really try to continue to evolve these core ideas like Amazon, Microsoft, and Visa into some newer ideas like HelloFresh and Square, etc. And we've done that with some success and obviously a few issues along the way as well. But from our point of view, it's all about following these structural growth trends to find these next big winners, because that's what's actually going to work on a 3 to 5 year view. The second thing I'd just flag in terms of positioning, sorry, I just went past it, is just to go back and think about, what we were saying earlier about long-term interest rates effectively being anchored. If you actually believe that what we said earlier, that long-term interest rates are anchored, then this is a good example of what everybody on the call's decision they're going to have to make for their investors. If we do manage to anchor interest rates here, then ultimately you as an investor can put your clients effectively into bonds and earn a 1 to 2% rate of growth. Here's Jerome Powell with 1 to 2% yield on long-term bonds with effectively no growth. You could, if you wanted to, move out towards these staples. What we're showing you here is revenue growth on the bottom and free cash flow on the left. And you could effectively move out to these staples and get a better free cash flow yield for a slower revenue growth. But you could also move out to what we think are probably going to become the new staples, which are these big tech companies that we've effectively circled the wagons around. These companies effectively have very strong revenue growth and very strong free cash flow dynamics. So I'd just put it to people on the call that, Microsoft with effectively 10% per annum growth, strongly leveraged to those cloud computing trends we're talking about, and a free cash flow yield of 3%, just seems like a vastly superior investment to us than long-term interest rates. And we'd say the same for Adobe, and we'd say the same for Amazon. And all we're doing when we move further out this curve is we're effectively taking a little bit more risk to effectively find the same outcome, looking at smaller companies that have faster growth, but really the same dynamics. And so from our point of view, ultimately the path of least resistance, if rates do stay here, is to move towards these companies. And you're starting to see that happen in the last 2 to 3 months. And we think that probably continues over the medium term. So I think the strong point there to say, Steve, is that the technology companies, as much as it's been a little bit of a dirty word in the first half of the year, we think is still very much the place to be over the next 3 to 5 years. And that's how the fund is positioned. Okay. In terms of beyond, sorry, Steve. Yep.
There you go, sorry.
Yeah, so in terms of beyond technology, just to touch on it really quickly, there are some other areas that we do focus on. So the fund is not just a technology company. As the economy reopens, the emerging consumer area of interest looks very interesting to us. These are companies that we think benefit from effectively increased spending and travel. And there we own companies like Montclair in the top left, or even Airbus, we think from the travel point of view. Semiconductors have been the weapons manufacturer in the war for now. They've been in the fund for a very long period of time, very strong performers for us, have both cyclical and secular characteristics. And lastly, climate. Climate is really the next big S-curve that we've been tracking for a while now. We do feel that we're right at the start of that one. And here there are obviously some exciting companies and obviously some glamorous sort of high multiple companies like Tesla, which we don't own today. But we also see quite a lot of boring companies here, or companies that people have previously considered boring, that we think can grow strongly through the cycle. Putting that together, these are the areas of interest that the fund's exposed to. So put simply, Steve, to answer your question, these are the areas that we had roughly at the start of the year. We haven't really changed them that much since the start of the year. The one thing we have changed is we have, I think in a couple of cases, sliced off maybe the highest multiple idea that we had in each one of these areas of interest. And the only other thing we changed is we have obviously sold all our China exposure. It did stop out of the portfolio back in February, March, and we have moved that out of the portfolio. And the last thing we've done is obviously lift that climate exposure a little bit. But from our point of view, what we're trying to show you here, and this is in the monthly and it's in the quarterly, these are the weights in the fund, the number of holdings and indicative positions. And what you can see is cloud computing is still the biggest area in the fund today at 15% with 4 holdings. Climate is still the second biggest at 15%. E-commerce, digital payments, internet disruption, high performance computing is still there at 10% and innovative health at the bottom. And so in all of these areas, we expect strong structural growth over the medium term. That's going to equal strong earnings growth over the medium term, and that's ultimately going to drive us towards our return targets that we're looking for these companies.
Okay, so Nick, I just want to go back to, you made quite a few comments around some of these technology names. Can you talk about the regulatory threats to these names, I suppose, in the US and also in China, considering some of the pressure that some of these tech names have been under in China?
Yeah, so regulation. Look, obviously we've answered this question for years. Sorry, I'm going the right way. We've answered this question for years in the US. And if you look actually on this chart here, you can see in Facebook and Google in particular, it is somewhat priced into these companies. Facebook and Google have for a long time had this so-called regulatory threat, and they've been battling these battles in both Europe and the US. It's important to stress that when they do get under regulatory pressure, they can actually have some wins here. Facebook has successfully had an FTC case thrown out in the courts, and Google has been investigated by the DOJ twice now, and both times they've dumped their investigation. And so the other thing to flag here is, importantly, these companies actually have recourse. So if regulatory change did happen in a big way, they could obviously appeal to the courts and use the power of the two systems, the two parts of government in the US to defend their position. And so this is not different to what we've seen over the last 100 years in the US. And obviously, I do expect regulation to continue with these or threats to continue for these companies, but we'd also flag that it is broadly priced into them today. China is unfortunately a different situation, and we're seeing that play out today. From our point of view, China, obviously you don't have the two systems, you don't have the two houses. So the regulatory threats that we've seen in China, while speculated for some time, they are now actually going through with. And this is quite concerning. And so from our point of view, it's important to flag we do run stop losses in this fund. We find them very useful. In fact, I'll go back and show you a picture just very quickly. Apologies for the flicking slides. But I suppose this is just a good advertisement as to how stop losses work. And so on the slide, I showed you the areas that we're looking at that we think are strong structural growth. And I showed you a number of companies. Now, I think it is unrealistic to expect that we've got all those companies right. And as most regular viewers will know, that we do run a stop loss regime here at Munro. Any company that falls 20% from peak or from cost is subject to a review. We review that position. We can all decide to keep it, but we can only keep it for 30 days. And in 30 days' time, we review it again. And this ultimately is designed to create this situation where we find these few winners that we talked about and we run them for long periods of time, but we can also cut our losers quite quickly. And ultimately creates a situation where we've actually never lost more than 100 basis points on any one stock in 15 years of running money. At the turn of this year, Alibaba was the biggest position in the fund. We were super excited about Ant Financial IPO, and we own Tencent also. Both those companies triggered in February. We decided to keep them for 30 days. I think Alibaba we halved, but we decided to keep them. And in 30 days' time, we had to review them again. And for Tencent, we had to review it again. And every time we looked at these things, we basically came to the conclusion that we did not know what was going to happen in China. And so the one case where we are going to put up our hands and say we don't know what's going to happen, it's China. Ultimately, there is no regulatory recourse that you get from, say, a Facebook or a Google here. And from that point of view, we've actually seen the worst case scenario play out for the education companies over the weekend, where they've effectively wiped out 100 billion in market cap by calling these companies not for profit. And so thankfully our stop losses worked here. We've moved to the sidelines. We're not saying China's not a great place to invest. We're just saying that we don't have visibility right now. And we think the safe thing to do is to stay to the sidelines and wait and see how this plays out, because we just quite frankly don't have the visibility. And I think it's interesting that the real regulatory threat ended up being in China, not necessarily in the US.
Okay, so let's get back to your areas of interest and have a closer look at some of these themes within the portfolio. Of all the structural themes going on in the world today, Can you talk about what structural theme you believe represents the biggest opportunity for investors who have a medium to long-term investment time horizon?
Yeah, so obviously we like all of them, Steve. But I think, if we had to flag, obviously, for a long time now, we've talked about digitalization, and you'll see digitalization is quite well represented in the fund. I think it's probably a good opportunity to talk about climate, because it's definitely one of the new areas in the fund, and something that I think people are going to be hearing a lot more about. Just to maybe go back a little bit. So why is this digitalization thing happening? Why is climate so important, and why are we going to hear more and more about this as the months and years go on? The key point to flag here is there's three big tailwinds converging. Firstly, investors care about what companies do. Companies need to be socially responsible because investors care about it. Money is being channeled into these funds, and that's not going to change in the short term. What that then results in is, in the middle, corporates set targets, generally for zero carbon by 2050, or some sort of carbon reduction plan. And then thirdly, we're seeing countries also set targets. And the pressure for this is really going to build leading into Glasgow, or COP26 at Glasgow on the 21st in November 2021, where you're basically going to see even Australia probably under a lot of pressure to commit to a zero carbon target. What this essentially means, from our point of view, is you are going to attempt to decarbonize the planet. I'm sure everyone on this call's got a view as to whether that's going to happen or not, but you are going to attempt to do it. It's effectively irreversible now. And you're basically setting up one of the biggest S-curves, we've seen in a very, very long time. It's going to cost potentially up to $30 trillion to do this. We'd argue that's a conservative number. We think it could be higher than that. And we have seen estimates out there as high as 50 trillion. It's important to stress it covers a whole bunch of things, not just electric vehicles. Interestingly, energy efficiency is actually a bigger share of the pie than, say, passenger EVs is, as is renewable energy is the same size as passenger EVs. So I know Tesla and the electric cars get a lot of the airtime, but there are actually a whole bunch of other beneficiaries out there. And so what we've done is take this pie and effectively turn it into this. And so what we're saying is we can set this into effectively 4 sub-trends. We think there's 4 sub-trends that are going to benefit from decarbonisation. The first is obviously renewable energy. Clean energy is going to be very important. The second is clearly energy efficiency, so obviously using less energy. The third is clean transport. And the last is the thing we call circular economy or recycling, etc. We're showing you a number of companies in our universe here, or a number of companies that we looked at as potential investments. And now I'm just going to dive into 2 of these pies and show you some actual investments. But from our point of view, this is setting up as a very big opportunity. And I think most people looking at these logos probably don't recognize many of them. There's a lot of good opportunities here, and a lot of them are very small with a very long runway of growth. And so we really do think this one sets up quite well for the next decade. Best example here, or a couple of quick examples here, would be energy efficient or renewable energy. Okay, so simple maths. This is where energy supply comes from globally today. Electricity is 19%. The rest is coal, gas, oil, others, etc. Of that 19%, only 10% is renewable. We need to get to 50% electricity minimum by 2050. You're not going to get rid of gas and oil entirely, but you have to electricity has to increase its share, and the renewable share has got to be more than 50% of the 50%. And so having gone from 10% of 19 to 50% of 50, you effectively get a 10x growth in renewable energy over that time frame. A lot of that's going to come from wind. This is where wind installations have to be today. This is where they have to get to by 2050 to hit zero carbon. This is where offshore wind is today. This is where it has to get to be zero carbon by 2050. And so from our point of view, there's really only 3 operators in the world that dominate the wind industry, being Vestas, GE, and Siemens Gamesa. There's a huge total addressable market that they can expand into. And Vestas is ultimately not that expensive a company today, listed in Denmark with effectively a 40 billion market cap on 15 times EBITDA. So that's a very simple OEM opportunity that is in the fund today. The other one I just flag really quickly is building an efficiency, just to really drive home, I suppose, this sort of hidden opportunity here. Buildings are the largest, or energy efficiency is the largest source of carbon emissions globally. A lot of that comes from buildings and their heating, ventilation, and cooling systems. most companies in the world are going to have to, or most buildings in the world are going to have to replace or update their heating and ventilation and cooling systems. A lot of people are using fuel oil, particularly in the Northern Hemisphere, and it all needs to move to electric. It needs to move to heat pumps. Look, we see this as a $350 billion opportunity over the next 10, 15 years. It means the whole market's going to grow at roughly 8% per annum, having grown at 4% per annum for the last 10 years. And so you can look at effectively 15% growth per annum in EPS for a lot of these HVAC companies or heating, ventilation and cooling companies. And the one we like here is Trane Technologies, listed in the US. It's one of 5 of the main players in the world today. We're paying roughly 29 times earnings, which is a little bit more than we'd like, but it's actually not that much when you think about, you know, the compounding effect that you're going to get here of 15% EPS growth effectively over a decade. As we do this entire replacement cycle of the entire world. And so coming back to the climate opportunity, we do think it's a super exciting one because very much like smartphones, it is effectively a transition. It's an energy transition that we need to go through. It's a refurbishment transition that we need to go through. And the more we look here, the more ideas we find that we like. And so I think that's the one that you're going to be hearing a lot more about from us over the months and years ahead.
Okay, great. I'm sure we'll get some more questions around that shortly. So this is the last question from me before we go to the audience Q&A. So as you discussed, you run 2 different portfolios. You've got a long-only concentrated portfolio and also the flagship long-short absolute return portfolio. So maybe, Nick, now is a good time just to touch on performance. And also just within absolute return, talk about what downside protection tools you currently have in place for the short-term period ahead.
Yeah, thanks, Steve. So just quickly here to talk about the funds. As I flagged at the start, we do have the absolute return fund and the long only product. In terms of how we report on those, it's important to stress the key difference between them is the absolute return fund. Both funds do the stuff in white, which is the ability to have an investment team that follows the investment process that picks growth equities. The absolute return fund has the ability to short sell, has the ability to hold up to 100% cash, has the put option protection, and really has that capital preservation mindset that people are attracted to with this product. That shows the net and gross exposure of the fund over time. And as you can see, you know, we do have these large drawdowns and exposure that allow us to effectively protect capital. We're not selling the whole fund here. We're just effectively hedging with different tools. We've shown these before. These are how some of those tools work, say in March 2020 quarter, and how we looked at the December quarter of 2018. Different quarters do different things in terms of how these downside protection tools work. Obviously, the COVID quarter was very good. The first half of the year was very much a rotationary market, a bit like that. From our point of view, ultimately, though, what we're trying to achieve on the Munro Global Growth Fund is this performance outcome. So what we're effectively trying to do is to achieve that double-digit returns through the cycle, of which we've done 17%, but do it with volatility that's below the market. And in this case, you know, the beta is below the market, yet the stocks we're investing in have a beta above the market. As we go forward with this product, Steve, you know, from our point of view, I think the conclusion of at least this part of the Q&A is we are quite bullish markets. We do feel that long-term interest rates are anchored. We do feel the world will reopen, but we'll only reopen once. And so ultimately, we will look forward to the medium-term earnings growth that you're looking for, and that will ultimately favour, you know, these structural growth opportunities that we're looking for. And so we're not struggling to find good opportunities here at, quite frankly, reasonably good prices, particularly when you compare it to long-term interest rates. And so from that point of view, we are reasonably fully invested. And it's really as volatility comes down, the put options that are going to help protect the fund through these things that we see in the past that could come from left field. And we're not pretending we know what's going to come from left field, but we are saying that we will try and insure against it. That's what we've done in the past, and that's what we'll do in the future. For completeness, the long-only product is a fully invested version of the same thing. And here the performance is compared to the market over the cycle. It is fully invested, and the relative returns there have been good also. A bit slower in the first half of the year, but I do expect that to pick up as we move into the second half of the year, as effectively people start to realise that medium-term earnings growth is what we're looking for.
Okay, excellent. Okay, well, let's move to Nick. Let's move to the audience Q&A, and there's quite a few questions coming through here. So the first one is around HelloFresh. Can you please run us through your thesis on HelloFresh? It seems to be the dominant player in the subscription food boxes. What's the opportunity in front of the company, and what's stopping, say, a supermarket entering this space?
Yes, thank you. So HelloFresh is one of our e-commerce ideas. Put simply, we've been following this structural trend for a long period of time. This is US retail sales in the US. This is e-commerce's share of retail sales. So coming back to what I've said repeatedly the whole way through, retail sales grow at effectively 3% per annum. E-commerce sales grow at 13% per annum. Why? Because they're taking share from regular sales. As you continue to move through the categories, it's very clear to us that groceries is the next big category to be disrupted. So e-commerce, started with electronic goods, or it started with toys, etc. And as everybody on this call has got more used to e-commerce, you started buying clothes online. Eventually, you started buying furniture online. And the last thing you're going to buy is groceries online. It is the biggest total addressable market out there, which is $1 trillion in the US. And prior to COVID was only 3% penetrated. So from our point of view, HelloFresh, to get your head around it, is not a subscription meal service that a lot of people think it is, including me when I first looked at it. We think it's just another way of buying your groceries online. And if you speak to anybody who uses HelloFresh, they'll generally say they do it because it's just more convenient. They don't have to think about what they're cooking at night. And so here's HelloFresh. It's the largest subscription meal service provider in the planet today, and it's 10 times bigger than its nearest competitor. Yet it's tiny versus the supermarkets. And so the simple trade here is that they're effectively going to take share from the supermarkets over time. Can the supermarkets do this? The answer is probably no. It's no different really to Amazon or what we saw from Amazon. The reality is that HelloFresh has these standardized facilities around the world today, which have helped them become the number one in the US with a 50% market share. And they're actually number one in 14 countries around the world today. And so from that point of view, supermarkets have the disaggregated supermarket network, which doesn't allow them to deliver fresh food directly to your door. You need this warehouse environment, and this is what we saw from Amazon. We're seeing the same thing from HelloFresh. So from our point of view, they are the dominant player, they are the leader, and I think the thing that's most exciting for us is, it's still quite small. It's only 12 billion euros market cap, roughly 16 times EBITDA today, or 25 times earnings, with this strong structural growth of earnings growth down here. They only have 7 million subscribers today, yet in the countries they're in, they could have up to 240 million. And that's before we talk about new countries. So there's really just a huge runway of earnings growth in front of it. And we're just quite frankly not paying for it. So it's genuine, a multiple bag opportunity here, and probably one of the stocks we're most excited about in the fund today.
Great. Okay, the next question, Nick, another stock, Tesla. Yes, no, maybe.
I'll keep this short. Tesla, we really like it, but the valuation has got to a point that we sold the stock in March. So we owned it for a period of time through last year. We sold the stock in March, well above where it is today. And we just think it's got ahead of itself. Unfortunately, we do set price targets at Munro. We built a model. It had a 2025 price target. It hit that. It then hit its 2030 price target, 8.5 years too early. And ultimately, we just felt the risk reward wasn't there. And so we like the company a lot. We just don't like it a lot at this price. And so from our point of view, if you hold it, I probably wouldn't sell it. But we're going to wait for a better opportunity.
Okay. Again, another investment thesis for ServiceNow.
Okay, yeah, great. So ServiceNow is really in this digital enterprise area. This is probably, as I said, the biggest area in the fund today. It's probably the most exciting area. To try and understand how cloud computing works, I think everyone now understands it to a certain extent because they've got a Zoom subscription. But what effectively happens is as you move more and more online, or as we move to hybrid work, we're going to use software much, much more. Software is generally moving to these subscription services or SaaS services. And most of them being run on the big infrastructure cloud players. And so this just shows you how it works. So these are the software companies at the top. This is the total cloud market growing over time at sectorally 700 billion today. At the bottom of the infrastructure of service players, of which there are 4 in the world: Amazon, Alibaba, Microsoft, and Google. And they're effectively, the commodity players in the screen. So Zoom, as much as it's a great interface, it effectively runs on Amazon Web Services and runs on Google Cloud. On top of this are some of the software plays. And your job here is to really understand how the network effects work to create these next big software winners. And so the best example we have today is Microsoft, where every single person on this call is probably a Microsoft subscriber now, and are actively stuck in the Microsoft system now for years to come. And Microsoft is the software company for the planet. ServiceNow and so what we're essentially looking at here is what is the next generation that are going to come through. And so here's Microsoft at 2 trillion, the piece of software that everyone needs. But we think most businesses are going to subscribe to between 5 and 10 pieces of software to run their business. And so who are going to be the next big ones that come through? We've obviously seen Adobe come through. We've seen Salesforce come through. You could look at Workday. You could look at ServiceNow. Ultimately, I mean, there's a lot of companies we could choose here. But Jeremy Gibson, who's our software specialist here at Munro Partners, has chosen ServiceNow. We've owned the company now for a couple of years, and it's a top 10 performer for us. And really, the ServiceNow, for people who don't know it, is it's effectively a platform for workflows within a business. So IT started as IT service desk in the cloud. So I think effectively Salesforce for the cloud. It then moves to employee workflows, so onboarding of employees, etc. It moves to customer workflows in terms of how customers can access your data, how things move through it, and then into creator workflows. And so what this means is they do this wonderful thing in software called land and expand. They start at one place and then they slowly become ingrained in everyone's organization. And so I've had multiple feedback from people in the field who say ServiceNow is actually written into their operating manuals. It's integral to how their business runs. And that just creates this huge total addressable market opportunity. So today, 5 billion in revenue out of a potentially 25 billion of customers. But what they could grow into is 175 billion and 216 billion. And they've already given you a goal of 15 billion in revenue by 2026. And so we just see this huge runway of growth in front of the company that's ultimately going to drive it towards its winners. Again, just showing you the same slides, again, from the start, the same process again. This is the EBITDA growth over time. This is their EV to EBITDA multiple, or effectively a proxy for cash flow. Yes, we're paying 53 times EBITDA for it. That's a lot. It's going to scare some people. But the runway for growth is so compelling, and we just think they are in that handful of potential winners in the future. And so it has been worth paying the multiple for this company over the last 3 years, and we think it's still going to be worth paying for it in the future.
Okay, thank you. Next question, do you have a view on what sectors/companies benefit from aging demographics, and if how personalised medicine fits into this thematic structural change?
Yeah, so personalized medicine or innovative health is what we call it. And so I'll keep this one maybe a little bit shorter, but this is an area that we look at quite a lot. It's really simple. You're using technology to shrink devices, or you're using technology to accelerate personalized medicine or medicine of different forms. And so the amazing statistic that I just want to remind people of is Moderna's vaccine and the Pfizer vaccine are mRNA vaccines, okay? This is the first time we've ever developed an mRNA vaccine. And if you speak to Moderna, and we do, they developed it within 4 days of COVID existing. So the vaccine solution was developed 4 days after Moderna started working on it. The last year and a half has been getting it approved and getting it built and getting it distributed into the marketplace. And so do not underestimate how much healthcare companies are using technology to improve the outcomes that we're getting today. And a lot of it is just the things that make things faster. And we're showing you this with pacemakers. That's what a pacemaker used to look like. That's what it was 10 years ago. That's what it is today. And so this is just a great structural growth opportunity for these companies. From our point of view, we're very much in the weapons manufacturers in the war here. So rather than choose specific drug companies, we're looking at these bioprocessing opportunities. This just shows the entire bioprocessing market. So this is personalized biologics, personalized medicine. Danaher is a huge investment here. They are the dominant player in this effectively equipment, and this is the equipment that you have to use to make it when you make a biologic. Again, another Jeremy idea. This one's been very strong performer over a long period of time. Ultimately holding the same multiple as its earnings growth accelerate as more and more drugs go towards biologics. And obviously COVID has helped this company considerably. Over time, they've got other ideas that we like here, particularly moving into genomics. potentially moving into other areas, but you generally find us play, the lower multiple weapons manufacturer in the war or shovel in the boom, rather than try and pick just one player like a Moderna or a BioNTech, which obviously we wish we had, but didn't really have an edge on who was actually going to create the vaccine or create specific personalized medicines. And so that's how we've done it today.
Okay. We might just quickly go back to Tesla. So there's a lot of talk about Rivian. Are you following Rivian?
Yes, because Amazon owns a big chunk of it, and Amazon's the biggest position in the fund. Rivian will come to market. I think you're going to be inundated with electric vehicle manufacturers. I think they all look really exciting. I think personally, or we think personally, not many of them are going to be good investments over the medium term. The hype is too high, and the outcomes are too far away. And within our climate area in particular, we can just find so many good ideas that are just quite frankly lying in plain sight. We've talked about Train Technologies. We've talked about Vestas. From our point of view, there are just so many ideas lying in plain sight that we don't need to stretch to electric vehicle manufacturers at the moment when everybody's looking there, and they are quite expensive.
Okay. Another one here, Nick. Have you uncovered any cybersecurity plays?
So the answer is yes, but none in the fund today. A lot of them are these SaaS type players at the top here. They have been very, very expensive. There are a handful that we like and track that we like quite a lot, but ultimately haven't had the opportunity to invest or got up the learning curve enough to invest at this stage. We would point out that the ultimate cybersecurity is to move to the cloud. And so Microsoft and Amazon are huge beneficiaries here. And most people would know that the Microsoft hack that has happened over the last 12 months is mainly happening to people who haven't migrated to the cloud with Microsoft. And so there is one way of playing, which is clearly Amazon and Microsoft. And then the specific vendors, it's very much, there isn't particularly, as far as we can see, one vendor that wins all here. Whereas, in services now case, there is one vendor that's dominant, and in some of these other areas, there's one vendor that's dominant. We just haven't found that one winner yet, but we are working on it.
Okay, just a couple of questions. I know we're getting close to 2 o'clock, but just a couple of questions here, just around how you structure the team and some of the cell discipline within the investment process. So, how do you structure your research team? Is it by theme, similar to some other managers like ARC, or by traditional GICS classifications?
Yeah, thanks. Great question. What we're doing here, and it's important to stress this. So as I said, we are continuing to build out the team. We have, sorry, 1 second. We have 7, 8 people on the investment team today, and I expect that to continue to grow. We organize our world by these areas of interest. So ultimately, we see the world has 30,000 companies in it, of which we have no hope of covering them all. There's a whole bunch that profess to grow, like Bank of America or like BHP, but we don't have an edge on those ones. And so what we really try to focus on is this secular growing universe, these companies that can grow regardless of the cycle. We've got it down to just under 1,000 companies. We split them into these areas of interest, be it climate change, be it innovative health, be it e-commerce, and we just went through some of them. In all of those different areas, we have a basket of companies that we ask the guys to bottom up prove some great ideas. And so what we're doing is we're trying to identify top down these areas of big structural change that I highlighted, and then bottom up, try and identify those winners. So bring it all the way back to what I said at the start, which is ultimately our goal here is to find those very few winners and to find those areas of structural change and the bottom up winners. From the team's point of view, what we're asking them to do is effectively we allow them to roam freely within the universe, quite frankly, and identify good ideas. People have different strengths in different areas, but we do allow them to come up with the best ideas. And so what we're asking them to do is to score the companies on a qualitative score on the left here, and then build an earnings model on the right here. So qualitatively, how does it score in our 5 key areas? And then quantitatively, what's the earnings of that company going to be? And so we will test them to basically prove that the company can double within 3 to 5 years. If they can prove the company mathematically can double within 3 to 5 years, then as a group, we will consider it for the fund. And so the team at the moment is we definitely organize our world into areas of interest, different team members have different strengths in different areas. So James Sanitas, if you don't know him, is much more in our climate side of things. Jeremy Gibson is much more in the software side of things that I spoke about, and Kieran Moore is definitely much more on the payments side. But we definitely do let people move around. But what we're ultimately trying to do is get people to come up with these great ideas that can double over 3 to 5 years. And what inevitably happens is they end up doing much better than that. And so every idea comes into the fund, and it's either going to become one of our great winners that works over a very long period of time, or it's ultimately going to leave the fund, either via a stop loss or it's going to hit its price target. But what we're trying to do is iteratively work our way towards those few winners that I talked about at the start. And we've honed this process over 15 years, but I still think we can get better at it. But that's essentially what you're paying us to do, and that's how we do it.
Okay, terrific. Well, Nick, maybe just maybe a last couple of comments from you. What's the one key takeaway you'd like to leave with everyone on the call before we wrap things up?
Yeah, so thanks, Steve. Apologies, I'm going to flick through a few slides here. And I think that last question helped us there. But look, I understand there's a lot of cross currents in the market right now. And I understand there's a lot of people looking at a lot of different things and making you think about growth versus value, or reopening versus not reopening, or inflation versus not inflation, or COVID versus not COVID. And I'll bring it back to what I said at the start. Earnings growth drives stock prices. That's effectively our North Star here at Munro Partners. This is a great picture just showing you Amazon, which is our #1 position in the fund, has been for nearly 10 years across 2 firms. This is the EBITDA growth of Amazon over time, and this is its share price. Its EBITDA has gone from 10 billion to 80 billion. They're reporting results later this week. I expect it to get to 100 billion, and the share price has followed it. But over the journey, this is the EV to EBITDA multiple that Amazon has traded at through that journey. Roughly 20 times is the average. But you can see it's re-rated and derated and re-rated and derated and re-rated and derated lots of times. And every time the multiple either re-rates or derates, it's because of something that's got nothing to do with Amazon. Amazon's continuing to execute. And whether it's something Donald Trump said, or Jerome Powell's over tightening rates, or inflation, etc. And I suppose what I wanted to remind people is wouldn't you be upset if you sold your Amazon because of something Donald Trump said in 2016? Or because Jerome Powell over tightened rates in 2018. The reality is they're 2 separate things. And so our job at Munro is to be your global growth investment manager. Our job is to effectively find these great ideas and run them for long periods of time, and to manage the risks along the way. And look, we recognize that's going to be a journey. And so I suppose the very last point I want to leave you with, I've done 2 last points, apologies, Steve, but is to please use our website. There's some great people like John Spenceley and Taylor and Bianca and our team who do a really good job of updating this website and really trying to give you the information that helps you recognize what we're trying to do here. We understand this is going to be a journey. It's never a straight line. It wasn't a straight line for Amazon. But what we're trying to do is get you to invest in this journey and to be your global growth manager, and to take you on the journey to help us find these great businesses for you that are ultimately going to drive the returns that we're looking for over the next 3 to 5 years and well into the future beyond that.
Great. Well, look, Nick, thanks very much for joining the call. We do have quite a few more questions, which we'll come back to you on. We'll get back to everyone who's asked a question. The guys at Munro will certainly come back to you on that. So, Nick, thanks again. Ladies and gentlemen, thank you for dialing in today and for your terrific support of Munro Partners and GSFM. As most of you know, the Munro Global Growth Fund is available as an unlisted fund, and also on all the major platforms. Along with it being available via the ASX, quoted under the ticker MAET. For those of you who prefer a long-only version of what Munro are doing, this too is available on platforms and will become available as a quoted ETF later in the year also. As Nick said, there's a lot of information at munropartners.com.au. You can also hit the GSFM website at gsfm.com.au. But once again, thanks very much for joining. And we look forward to seeing you all again, hopefully very soon in person. Thanks very much, and have a great day.
Thank you. Much appreciated.